stock market averages closing out the week in the red. This as rising treasury yields drive stocks lower. The yield on the 10-year note yield topping 1.6 yesterday. It's now pulling back in a big way. Let's bring in Jeff Sherman from DoubleLine Capital and David Zervos from Jefferies. Welcome to both of you. Jeff, just on the move right now, we got as high as 161 yesterday. Yesterday on the 10-year, I think we're like 138 right now. The size and speed of these moves does not feel normal. Jeff, what's happening?
Well, I don't think anything's been normal the last year, Sarah. But on that front, we saw yesterday a very weak 7-year Treasury auction, and it coincided with the sell-off in Treasuries. And as soon as you hit the 150 level, it just looked like there was massive stop losses there. And so it's a sharp reversal. It happened very quickly. It kind of normalized a bit. Then we had massive volatility in the afternoon as people were trying to digest what was going on. But I think what I've heard from some of your guests earlier today, I really agree with. Last year, this was all about repricing inflation. And so what you saw there was the break-even spreads with the bonds measured inflation that were pushing yields back up. But we've seen in the last couple of weeks that now the bond market and the treasury market is starting to believe in the real growth story. That is, real yields are pushing up. And I just think there was something kind of a haywire with essentially that stop loss trading there. And you're seeing the reversal today. I mean, the bond market has been oversold. When I'm saying the bond market, I'm talking about treasuries here. If you look at relative strength in those indices, they've been giving very extreme readings really persistently for like 2 weeks now. So it's due to have a little bit of correction. And so I think you're overshooting both directions here. But I think the story here continues to be that we are in a march higher in yields. And we know that nothing moves in a straight line. There's a lot of volatility here. People didn't think the 10-year would go above 120, 125. They were questioning the Fed, whether they do yield curve control and step in here. And the Fed's committed not to do that at this point. So I think we have a continued rise. We see fair value on the 10-year being north of 2. It's not going to happen overnight. It's not going to happen next month. But it is likely to happen through the course of the year. So I think the volatility is there. It's just people are trying to react all of a sudden. And we hadn't seen any volatility really in the Treasury market prior to that.
So, Jeff, yields, in your view, spiked a little bit too quickly and maybe due a bit of a correction, which is perhaps what we experienced today. But is that just a temporary and short-lived correction? And where do you see the yields being in 6 to 12 months' time? And with it, is the dollar going to move in the same way, i.e. today, bouncing a little bit, but still going to continue in a month or so's time on its downward trend?
Yeah, we definitely have had that view for a while there, Wilfred, although we kind of got neutral on the dollar after some of that sell-off last year, and it really hasn't made headwind. So in order to get short the dollar again, I'd want to see it really start to move down or buy other currencies is what I mean by short the dollar as well. But for the Treasury market, you know, a lot of the metrics we look at, whether that's looking at nominal GDP models or things like a copper gold ratio, a lot of the signals we look at really show that you should have a 2 handle on the 10-year at these levels today, if not something in the mid-2s at this point. And so I think that the market is realizing, if you go back over the last year, we saw a rally in stocks. We saw a rally in credit. We've seen spreads compress massively, and the rates market was holding out. Yes, we set a low in rates back in March. It's been an 11-month climb, but it's been a very boring one. And there's been a lot of volatility in the last couple of weeks within the rates market, as I think you're starting to see us perk up. Maybe some of it's the vaccination, actually people getting dosages. But you're looking at these GDP forecasts for this year that are 5, 6% on a real basis from a lot of folks out there. And you slap on inflation there, you're talking about a very, very pronounced correction if indeed that comes to fruition. But even if it doesn't, let's say we grow at a 4.5%, 5% nominal rate. So some inflation, some real growth rate in there. A 140 10-year doesn't make a lot of sense in today's market. So I agree with David as well. And thinking about risk parity, we've been telling folks for a long time that you got to be careful with the duration, the rates in your portfolio with very low yields. But the other thing that no one's really talking about, look at the bloodbath in the corporate bond market. This is really due to the rate side. It doesn't have to do with spreads or default risk, but there's so much rate risk in the investor-grade corporate bond market. And you see it if you look at some of the ETFs that traffic in these investor-grade corporate bonds. They have a record amount of short interest in them today. So there's investors looking to try to make money on some of these moves, and it's not just in rates, it's actually thinking about the corporate component side because it has so much rate risk. So, Wilfred, we do think that we continue this march higher. It's been oversold for a while, but I think the most important thing the investors need to take away here is really think about the duration risk, think about what you want your bonds to do in your portfolio. And if you don't like this volatility, you can always shorten up a little bit. And if David and I are right, you can reload up again at a higher level.
To have the two healthy beards side by side. Sorry, I wasn't taking part.
And we miss your beard.
Yeah, well, I do too.
Wilfred, join us anytime.
But frankly, I would be put to shame if I was alongside you both. Anyway, we're really out of time. Jeff, David, thank you both very much.